Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
Great to be back.
Today, we're breaking down one of the giants in the biopharmaceutical space, Amgen.
A fascinating company. Been around for decades, a real pillar in healthcare.
Absolutely. They've delivered some truly groundbreaking medicines, but, right now, Amgen's at a really interesting crossroads. A pivotal moment, you could say.
Definitely facing some significant challenges, but also maybe some equally significant opportunities down the road.
On the surface, it's a powerful, established business. But the real question for us as long-term investors is this. Are there hidden cracks in the fortress that the market is ignoring, or is this a company gearing up for another decade of innovation? That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use interactive brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comments section.
Perfect. Now let's get into it. Pillar number 1, the business model. Unpacking Amgen's core business.
Right. So let's start right there. The engine of Amgen. How does a company like this actually work? What's the core business model?
Well, at its heart, Amgen is running a classic but incredibly high-stakes, research-intensive biopharmaceutical operation.
Meaning R&D is everything.
Pretty much. Their core activity isn't just, stamping out pills. It's the deep, long, expensive work of discovering, then developing, and finally commercializing genuinely innovative biologic medicines.
And these are for serious illnesses, right? Not just everyday things.
Exactly. They focus on serious, often life-threatening conditions, particularly where current treatments aren't cutting it, addressing what the industry calls unmet medical needs. It's like a constant scientific race against disease.
Okay, so pioneering new solutions for big problems. How does that turn into revenue? Are they selling these directly to you and me?
No, not directly to patients. The money comes overwhelmingly from selling these proprietary, patent-protected drugs.
Proprietary and patented, key words there.
Absolutely. They sell these medicines in huge volumes to large wholesalers and distributors. Think of the giants like AmerisourceBergen, McKesson, Cardinal Health. They're the ones who handle the complex logistics, getting the drugs to hospitals, clinics, pharmacies worldwide. It's really a B2B model.
Right, and that's where the profit comes from. These specialized biologics must command high prices.
They do. They generate really substantial gross margins on these sales. And that margin isn't just profit. It has to be substantial because it needs to cover enormous ongoing investments in R&D.
We're talking billions.
Billions every year. A relentless commitment to science. Plus, it covers their significant dollars. Selling, general and administrative costs, SG&A. Marketing these complex drugs, educating doctors, running the global operation.
Well, R&D and SG&A eat up a lot of that margin.
A huge chunk. There's a smaller slice of revenue from things like royalties or collaborations, maybe on drugs they've partnered on, but really, direct drug sales are the main engine. No question.
So the science itself is incredibly complex, right? Biologics, large molecules, living systems. It sounds like rocket science. But the business logic, for us trying to understand it, it seems, surprisingly straightforward.
It really is, at its core. The basic idea is to invest incredibly heavily in scientific innovation, often for 10 years or more per drug, to create something truly unique and effective. Something that genuinely improves patient outcomes where other things haven't.
And because it's unique and effective.
And addresses an unmet need, it can command premium pricing during that period when the patent grants them market exclusivity. A temporary monopoly, essentially. It's high stakes, high reward. Driven by breakthroughs, protected by patents.
What gives this model its endurance, though? Why has this worked for Amgen for so long, despite all the competition and regulatory pressure?
Well, there are a few fundamental forces at play. First, and maybe the most basic, is the demand itself. People always want better health, longer lives. That demand is persistent, it's inelastic, it's not like buying a car, it's non-discretionary.
Healthcare spending tends to hold up even in recessions.
Exactly. It's almost a biological need. Second, you've got the relentless pace of scientific advancement. Fields like human genetics, molecular biology, they're constantly opening new doors, finding new targets, creating new opportunities to tackle diseases. It's a continuous cycle.
And you mentioned biologics specifically. Does focusing on those add another layer of protection, a higher barrier for competitors?
It absolutely does. This is a critical point. Biologics are large, complex molecules. Think antibodies, proteins. They're often made using living cells, totally different from traditional small molecule drugs made through chemical synthesis.
Harder to make.
Much harder. Manufacturing biologics is incredibly complex, precise, and expensive. It's not like just copying a chemical formula. This complexity makes them inherently more difficult and costly for competitors to replicate, even after the main patents expire.
So even when the patent runs out, it's not easy for generics or biosimilars, in this case, to just jump in.
Right. It creates a significantly higher barrier to entry. It means Amgen often enjoys a longer period of market dominance and gets a more durable revenue stream from each successful biologic compared to traditional drugs.
Okay, so a powerful engine focused on complex biologics. Let's talk about the output. Their product portfolio, it seems quite diversified.
It is, and that diversification is really a key part of their strategy, their risk management. The portfolio is built across 4 main therapeutic areas.
It charts.
General medicine, that includes big areas like cardiovascular health and osteoporosis. Then oncology, obviously cancer treatments, inflammation, dealing with autoimmune conditions, and importantly, rare diseases.
And that rare disease part got a big boost recently,
A
right?
huge boost from a major acquisition, which we'll definitely dig into. But this structure, spreading bets across these pillars, is crucial. It reduces their dependence on any single drug or disease state. Spreads the risk.
And they've had a lot of success within those pillars. How many blockbusters are we talking about? Products over $1 billion a year.
It's pretty remarkable. As of fiscal year 2024, Amgen had 14 products, each doing over $1 billion in annualized sales.
$14 billion drugs. That's serious scale.
It really is 14 distinct, significant revenue streams. It shows the depth of their pipeline and their commercial strength over the years.
Let's touch on some of the biggest ones. Prolia and XGVO for bone health. You mentioned those were key.
Absolutely. They're a combined powerhouse. Prolia for osteoporosis, XGV, often for bone issues related to cancer. Together, they brought in about $6.7 billion in 2024.
Wow. And still growing.
Showing steady, solid growth, around 7-8%. That reflects that persistent demand for bone health solutions. These are really important cash cows for Amgen right now, funding investment in other areas.
Okay. What about Enbrel? That's one of their oldest, most famous drugs for autoimmune conditions. How's that doing? I heard sales are declining.
Yeah, Enbrel is a foundational drug, no doubt, pulled in $3.3 billion last year. But as you said, sales were actually down about 10%.
Is that biosimilar competition finally hitting?
Not yet in the U.S., actually.
Yeah.
Its main U.S. patents are still holding until 2029, believe it or not. The decline is more about the intense innovation in the autoimmune space. Newer drugs, maybe more targeted, maybe easier to take, are gaining traction. So it's facing pressure from next-generation therapies, not just copies.
Interesting. Okay, how about Repatha for high cholesterol? That seems like a growth story.
Definitely. Repatha hit $2.2 billion in sales, and that was with impressive 36% growth year over year. It's PCSK9 inhibitor, targeting tough-to-treat high cholesterol. Its success really highlights the ongoing unmet need in cardiovascular health.
And Otezla, the oral anti-inflammatory.
Otezla brought in $2.1 billion. It also saw a slight dip, down 3%. It's an oral option for things like psoriasis, which is convenient, but it's also in a very crowded market.
Now, those new rare disease drugs you mentioned from the recent acquisition, Tepezza and Krystexxa, how much are they contributing already?
They're already making a significant impact. Tepezza, which is for thyroid eye disease, a really debilitating condition, added $1.9 billion. Since it was just acquired, you can't really do a direct year-over-year growth comparison the same way, but it's a major new revenue source.
And Krystexxa?
That one's for chronic refractory gout, another tough condition. It added $1.2 billion again. A significant new pillar.
Yeah.
And then you have others contributing strongly too, like Evenity, another osteoporosis drug, growing fast at 35% to $1.6 billion. And Kyprolis for multiple myeloma, up 7% to $1.5 billion.
So a real mix, established cash cows, strong growers, and these new potentially high-growth rare disease assets. But it sounds like the very thing that makes this business model work, the patents, is also its biggest vulnerability.
It absolutely is.
Yeah.
It's the core tension of the whole industry. Patents grant that temporary monopoly, which allows for high profits to fund R&D, but patents expire. That finite lifespan leads inevitably to the patent cliff.
A term we hear a lot.
And for good reason. It's a recurring, almost existential threat. Amgen constantly has to innovate, develop new drugs, and acquire new assets just to replace the revenue that will eventually disappear when blockbusters lose exclusivity. That tension drives everything, R&D strategy, M&A decisions. It's a perpetual race.
Okay, let's dig into that race and the state of Amgen's defenses. We've talked about patents as their competitive moat. How strong has that fortress historically been?
Historically, incredibly strong. Amgen's moat is overwhelmingly built on those intangible assets, its massive patent portfolio. These aren't just pieces of paper. They grant legal monopolies for a defined time.
Preventing competitors from launching copies.
Exactly, preventing biosimilars. That exclusivity is what allows for premium pricing and generates those high margins and strong cash flows we talked about. It's the bedrock.
Can you give us a concrete example, like how long can this protection really last?
The classic, almost unbelievable example is Enbrel, approved way back in 1998 for autoimmune diseases. Its U.S. market exclusivity has been defended and extended remarkably, all the way out to 2029.
2029. That's over 30 years of protection. How did they manage that?
Not with just one patent. It was achieved through what's called a patent thicket. Imagine a dense web of interconnected intellectual property. It covers the core molecule, sure, but also manufacturing methods, different formulations, delivery devices, specific ways of using the drug, layer upon layer of protection.
So it's like building multiple walls around the castle.
Precisely. And despite numerous very expensive legal fights, notably with Novartis trying to launch a biosimilar, Amgen's defenses held firm in the U.S. This incredible longevity allowed Enbrel to generate over $70 billion in cumulative sales. $70 billion.
Wow.
It's a textbook case of how powerful a well-managed patent estate can be, turning a discovery into a decades-long revenue stream.
An amazing historical strength. But you said the moat is, quote, unambiguously narrowing. Why now? Is it bad strategy or just time?
It's really just time. Despite that history, the moat is narrowing. And it's crucial to understand this isn't necessarily because of strategic mistakes. It's the natural, inevitable life cycle of pharma products. Patents expire. And Amgen is now facing a very significant patent cliff.
Meaning multiple big drugs losing protection around the same time.
Exactly. Several of their largest, most profitable drugs are facing loss of exclusivity LOE between 2025 and 2030. The clock is ticking down.
Okay, this isn't a surprise then. Which specific products are on the edge, and what does that mean for revenue?
The most critical one right now is the Prolia/Xgeva franchise, that bone health powerhouse. $6.7 billion in sales last year. It faces LOE starting in 2025.
That's soon.
Yes. In fact, Amgen already settled with Sandoz, a major biosimilar maker. Sandoz can launch its Prolia/Xgeva biosimilar in the U.S. in May 2025. That's a clear signal. The peak profit era for these drugs is ending. Biosimilar competition is coming, and it will hit revenue hard.
And Enbrel, even with protection to 2029 in the U.S., you said it's already declining, still vulnerable.
Yes. Even with that strong U.S. patent, its sales are slipping, as we discussed. That's due to newer, arguably better treatments emerging in the autoimmune market. Doctors just have more options now. So the patent protects against direct copies in the U.S., but not against superior innovation.
Okay. What about Otezla?
Otezla is also on the list, expected to face generic competition likely towards the end of this decade.
Yeah.
So another major revenue stream facing erosion.
Prolia, Xgeva, Enbrel, Otezla, these are huge drugs. What's the potential overall impact? How much of their current revenue is actually at risk here?
It's substantial. Some analyst estimates suggest that products accounting for maybe up to two-thirds, 67% of Amgen's current revenue are at risk from these patent expirations over the next 5 to 7 years.
2/3. That's enormous.
It absolutely is. It frames the core challenge perfectly. The judgment on Amgen now really hinges on how effectively they can use the profits from the drugs still inside the fortress to build the next fortress. It's a massive reinvestment challenge, a race against time fueled by current cash flows.
Okay, let's shift perspectives a bit. Inside that fortress, how do customers and employees see things? Starting with customers, patients, and doctors, what's the feeling about Amgen's products themselves?
It's really interesting you see the strong dichotomy. On one hand, there's often real appreciation, even loyalty, based on the effectiveness of the drugs.
Like they really work.
Yeah. often life-changingly so. You hear stories from patients using Repatha, for example, showing dramatic improvements in complex cholesterol markers like ApoB or LPA, things doctors look at for serious risk reduction. Patients talk about getting hope they didn't have before.
So real clinical impact builds trust.
Absolutely. Same with Enbrel for autoimmune conditions. People describe it as a godsend for conditions that were destroying their quality of life. That effectiveness, backed by science, builds strong physician confidence and patient loyalty.
That sounds great, but I feel a but coming. Is there a downside to the customer experience?
There's a big but. That love for the product often clashes sharply with frustration over access and cost.
Ah, the pricing issue.
Yes. Widespread complaints about the high price tags, and maybe even more about the incredibly complex, bureaucratic, and often adversarial process of getting insurance to actually pay for it.
Prior authorizations, denials.
Exactly. Patients in doctors' offices spend countless hours battling insurance companies over prior authorizations, appealing denials, dealing with huge co-pays that can make the drug unaffordable even if it's approved. It's a massive source of stress and anger.
So it's like Amgen has two different customers with conflicting priorities.
That's a great way to put it. You've got the end user, the patient and doctor focused on clinical outcomes. And you've got the payer insurance, government focused almost entirely on controlling costs. The friction there is immense.
And that creates risks beyond just patient frustration.
Definitely. It fuels political debates, regulatory scrutiny, and poses a significant long-term reputational risk for Amgen and the whole industry. It's a fundamental tension.
Okay, let's turn inward now. What about the employees? What's the culture like inside Amgen? Is it a place top scientists and professionals want to be?
Generally, the sentiment seems pretty positive. The company really pushes a mission-driven, patient-centric culture based on science and innovation. And that seems to resonate. You look at employee review sites, comparably, they show something like 80% positive reviews. That's quite strong.
So, mostly a good vibe, but I imagine in a huge company, experiences vary.
They absolutely do. Like any giant corporation, the day-to-day reality can really depend on your specific team, your direct manager. Some people report great work-life balance, supportive teams. Others mention pockets of micromanagement or even toxic environments in certain areas. It's not uniform.
Are there common complaints that pop up? Things that might be wider issues?
Some recurring themes are feeling like just a number in a massive organization, which isn't uncommon in large companies. There's talk of increased workload, sometimes linked to cost-cutting efforts, and concerns about compensation maybe not keeping pace with the red-hot biotech market, especially for top R&D talent.
That competition for talent must be fierce.
Incredibly fierce, so compensation is always a sensitive point.
Any more serious concerns? Things like fairness, career paths?
There are some isolated but definitely notable complaints about ageism. Some long-serving employees feeling like they're being pushed aside or undervalued.
That could be a risk long term.
It could. If that perception became more widespread, it could really hurt talent retention, morale, and crucially, you risk losing deep institutional knowledge. It's something management needs to keep a close eye on.
Okay, that brings us nicely to management. Robert Bradway, CEO since 2012. Over a decade steering the ship through these changing waters. What's the read on his leadership and stewardship?
Well, that decade-plus tenure provides real stability, which is valuable. And his background is quite fitting for the challenges Amgen faces. Before CEO, he was CFO at Amgen. And before that, healthcare investment banker at Morgan Stanley.
So deep financial and strategic background.
Exactly. He understands the science side, of course, but he also deeply understands the financials, capital markets, M&A. He speaks both languages, which is critical for a company like this.
What seems to be his core philosophy? What does he emphasize?
Looking at his shareholder letters, his public comments, you see a very consistent, disciplined approach. It's clearly owner-oriented, focused on the long term. He constantly hammers on innovation R&D as the core engine. The goal is always a broad and deep pipeline, delivering first or best-in-class medicines. He explicitly talks about positioning Amgen for attractive long-term growth, looking out to 2030 and beyond, not just the next quarter.
And diversification.
Yes, he stresses the value of that balanced portfolio across the therapeutic pillars to mitigate risk. And critically, a commitment to rational capital allocation.
Meaning deploying cash wisely.
Precisely. Prioritizing R&D investment, absolutely, but also returning cash to shareholders through dividends. And, when it makes sense, Buybacks. It's about balancing reinvestment and returns.
Let's look at that track record. How have they actually allocated capital under Bradway, especially facing this patent cliff?
They've definitely put their money where their mouth is on reinvestment. R&D spending hit a record $6 billion in 2024. That was a huge 25% jump year over year. That's aggressive investment.
Signaling belief in the internal pipeline.
Seems so. And they're also spending big on manufacturing planning, about $2.3 billion in capital expenditures for 2025 to expand and upgrade facilities. That's essential for biologics.
But the really defining move, the one everyone talks about, is the Horizon Therapeutics acquisition, nearly $28 billion. How does that monster deal fit the strategy?
It's absolutely the defining strategic move of his recent tenure. That $27.8 billion deal in late 2023 was a direct, bold answer to Amgen's biggest problem, the patent cliff.
How so? What did Horizon bring?
It brought a portfolio of what they call first-in-class, early-in-life cycle rare disease drugs. Key assets like Otezla and Crestix, these are drugs addressing high unmet needs with long patent lives ahead of them. It instantly created a major new growth pillar. It was essentially buying future growth and diversification.
But they paid a hefty premium, right? Almost 50% over the pre-deal price. Was that too much, especially given the debt?
It was a significant premium, no doubt. That reflects the quality and scarcity of assets like Horizon's. But the argument is these are high-quality drugs, they fit well with Amgen's biologics expertise, and Amgen's global reach can accelerate their sales. Management expects the deal to be accretive to non-GAAP EPS starting this year, 2024.
Meaning it should add to earnings per share after adjusting for non-cash items?
Correct, which is key for justifying the price tag to investors.
How did this massive deal affect their approach to shareholder returns, like dividends and buybacks? Must have required some adjustments.
It did. Amgen has a great track record with dividends, 13 straight years of increases. Very shareholder-friendly. And they used to buy back a lot of stock. But after taking on all that debt for Horizon, they made a very prudent call.
Which was?
They significantly pulled back on share repurchases, capped buybacks at just $500 million for 2025. That's a clear signal. Prioritize paying down debt over artificially boosting EPS with buybacks right now.
So leverage up for a strategic buy, then focus on deleveraging. Seems rational.
Exactly. That sequence, bold acquisition, then disciplined debt reduction. It really looks like rational long-term thinking. Prioritizing the strategic health of the company, rebuilding the growth engine over short-term financial cosmetics. It's a calculated reinvention.
Okay, so the strategy seems clear. How does the company look financially today? After that reinvention started? Is it still a financial fortress, or are there some temporary weak spots?
Well, for years, Amgen was a definition of a reliable earnings machine, consistently generating huge revenues and profits. Now, GAAP net income can bounce around a bit.
Why is that?
Often due to non-cash accounting stuff from acquisitions, like amortization or mark-to-market investment changes. Things that hit the accounting profit but aren't about the core operation.
So look beyond GAAP.
Exactly. Look at their non-GAAP operating margin. That tells you about the core drug business profitability. And it's been incredibly strong and stable, consistently in the 45% to 52% range. That shows the underlying economics are powerful.
Let's dig into key ratios. Return on invested capital, ROIC. How's that looking? It tells you how well they use their capital.
Historically, Amgen's ROIC was excellent, often 10% to 16%. Way above their cost of capital. That's a sign of a superior business, a wide moat.
But what about recently, after the Horizon deal?
Right. The most recent full-year ROIC for 2024 dipped to about 8.9%. That's an expected direct result of the Horizon deal dumping tens of billions in new capital debt and goodwill onto the balance sheet before those assets are fully generating earnings.
So the denominator went way up before the numerator caught up.
Precisely. A key thing to watch now is, can management integrate Horizon effectively and get that ROIC climbing back towards its historical levels? That's the test.
Okay. What about cash flow? How good are they at turning those accounting profits into actual cash?
This is where Amgen really shines. They are an exceptional cash generator. Their free cash flow conversion, FCF, divided by net income, is consistently well over 100%.
Over 100%? How does that work?
Remember those big non-cash charges like amortization of intangible assets from acquisitions? They reduce GAAP net income, but they don't reduce the actual cash coming in the door. So in 2024, they had like $10.4 billion in FCF on only $4.1 billion in GAAP net income. That's over 250% conversion.
Wow. So tons of actual cash being generated.
Absolutely. And that powerful cash flow gives them huge financial flexibility to pay down debt, fund R&D, pay dividends. It's a massive strength.
Which they need, given the debt from Horizon. How has that deal impacted the balance sheet leverage, net debt to EBITDA?
Yeah, the balance sheet looks quite different now. Total debt is around $57.4 billion. Cash is about $8.8 billion, so net debt is roughly $48.6 billion.
And EBITDA?
Trailing 12-month EBITDA is around $14.2 billion. So do the math. Net debt to EBITDA is about 3.4x.
How does that compare historically for Amgen?
It's definitely elevated. Historically, they ran with much lower leverage. This 3.4x is manageable. The cash flow covers interest easily, about 3.4 times over, but it does reduce their margin of safety temporarily. Deleveraging is clearly priority number one for capital allocation now.
So looking back over 10 years, the picture is a company deliberately trading its pristine balance sheet for a shot at renewed growth.
That's exactly the narrative the financials tell. They use their financial strength to make a transformative bet to address the patent cliff. The investment thesis today absolutely rests on the acquired assets, delivering enough growth to restore those historical financial quality metrics while the strong core cash flow pays down the debt.
Okay, let's pull it all together. Considering the business, the moat, the management, the financials, what about the valuation? Is Amgen priced fairly right now for a company in this transition?
The market seems to be pricing Amgen with, let's say, a healthy dose of caution. It reflects this ongoing transition. If you look at trailing PE, it might look high, but again, that's skewed by those GAAP accounting charges from the acquisition.
So better to look at forward PE, or price to free cash flow.
Definitely. The forward PE, based on analyst estimates, is running around 14.3x. Compare that to Amgen's own 5-year average PE of almost 26x. 14.3x looks quite reasonable, maybe even a bit cheap relative to its history.
And price to free cash flow.
That's sitting around 15.3x on a trailing basis, which is right in the middle of its historical range of roughly 11x to 20x and pretty close to its 5-year average of 16x.
So what's the conclusion on valuation? Bargain. Overpriced. Fair.
I'd call it a fair entry point for a long-term owner. The market clearly recognizes the quality, the cash flow, the good management. It's not giving it away cheap. But it's not demanding a premium either because of those big known uncertainties. The patent cliff impact and the execution risks around Horizon and the MariTide obesity drug.
So you're paying a fair price for a shot at management successfully navigating this.
Pretty much. It's a bet on execution at a price that doesn't require perfection but does require solid progress.
Let's talk about that future then. What are the main growth engines Amgen is counting on, and what are the real, potentially permanent risks?
The growth story really rests on two main pillars now. First, that rare disease portfolio from Horizon. Drugs like Otezla and Krystexxa, they're early in their lives, target high unmet needs, face limited competition. That should provide a solid base of durable, high-margin growth for years.
That's the foundation. What's the potential upside kicker?
That's MariTide, the obesity drug candidate. That's the potential game changer, the Wildcard. The obesity market is enormous and growing incredibly fast.
And MariTide showed promise.
Phase 2 results were impressive in terms of weight loss, around 20%. And crucially, it has a potentially differentiated dosing schedule, maybe monthly or even less frequent. That could be a huge advantage in a market where weekly injections are the norm. If this hits big, it could totally reshape Amgen's growth profile.
Sounds exciting. But what about the dark side? What are the genuine risks that could permanently damage the company and not just cause a temporary dip?
Number one, without a doubt, is failure to navigate the patent cliff. If the Horizon drugs disappoint, if the internal pipeline doesn't deliver new blockbusters fast enough to replace Prolia, Xgeva, and Enbrel, Amgen could face years of stagnation or decline. That's the core execution risk.
And the obesity bet itself, MariTide, that's not a guaranteed win, is it?
Far from it. That market is rapidly becoming dominated by Novo Nordisk and Eli Lilly, two absolute giants with very effective drugs already entrenched. And MariTide's Phase 2 data, while showing good efficacy, also showed significant GI side effects causing a high number of patients to drop out.
So tolerability could be an issue.
It could be. If MariTide ends up being seen as just me too or having a worse side effect profile, that multi-billion-dollar R&D investment is lost, and that huge growth opportunity vanishes. It's a high-risk, high-reward bet.
And then there's systemic risk hanging over the whole industry, drug pricing.
Yes, that's the big external threat. The entire pharma business model relies on that period of patent-protected high prices to fund the next wave of innovation. If governments, particularly the U.S. with the Inflation Reduction Act, get more aggressive with price negotiations, it could fundamentally lower the profitability of the entire industry.
Permanently reducing the return on R&D investment?
Exactly. That would hit the long-term earning power and pipeline value for Amgen and everyone else. It's a major structural risk.
Okay, this brings us to that second-level thinking. The market consensus seems clear. Amgen's a solid company facing a huge, obvious patent cliff. A show-me story. Future depends on Horizon integration and the MariTide lottery ticket. But is there a more nuanced view the market might be missing?
I think there might be. Look, the challenges are real. No one disputes the patent cliff or the MariTide risk, but the market might be underestimating the sheer durability of Amgen's existing cash flow and the strategic flexibility that cash flow provides. The market often thinks very binary. MariTide hits or misses, the old drugs fall off a cliff instantly on LOE date. But biologics, especially established ones, tend to have a much longer revenue tail than small molecules, even with biosimilar competition.
Because they're harder to make and doctors are used to them?
Exactly. Manufacturing complexity, physician loyalty, established distribution. It means the decline is often more gradual. That tail will likely keep generating billions in free cash flow for years, longer than maybe the market anticipates.
And that cash flow helps with the debt.
Massively. The market sees the Horizon debt as this huge overhang. But if the underlying cash flow is more resilient, Amgen can potentially pay down that debt faster, de-risk the balance sheet quicker, and regain strategic flexibility for more M&A or shareholder returns sooner than currently priced in.
So the differentiated view is that the market's maybe too focused on the new risks and underpricing the resilience of the old cash machine.
That's the core idea. The resilience of the existing business provides a bigger margin of safety against the execution risks than the current narrative might suggest. It's not just about the growth bets. It's about the strength of the foundation supporting those bets.
Okay, let's try to wrap this up. Summarize the bull case, the reason someone might want to own Amgen for the long haul.
Sure. The bull case is you're buying a durable business in an essential sector, human health. They have deep expertise in complex biologics, creating higher barriers to entry and longer product tails. You've got rational, proven management under Bradway with a track record of smart capital allocation. The Horizon deal being a bold strategic move to address the core risk. The company generates exceptional free cash flow, consistently over 100% of earnings, giving huge flexibility. And there are multiple paths to growth. The rare disease portfolio provides a solid base. They have a growing biosimilars business, meaning it's not all riding on the MariTide outcome.
Makes sense. Now, the bear case. The reasons to be cautious or stay away.
The bear case is equally compelling. There's that imminent severe patent cliff-hitting key drug starting next year, creating a massive revenue hole to fill. There's significant execution risk and high leverage from the expensive Horizon deal. Net Debt-to-EBITDA, around 3.4x, reduces the margin of safety. Competition in the crucial obesity market is incredibly intense, and MariTide's profile might not be good enough, risking billions in R&D. And overarching all of this is the systemic threat of drug pricing reform, potentially crushing industry profitability long term.
So, a clear tension between opportunity and risk. Let's leave our listeners with provocative thought. Our red team challenge. The bull case says management cleverly bought the next decade of growth with Horizon. But what if you invert that? What if they actually leveraged up to buy yesterday's growth at a premium, while the real future of medicine is happening elsewhere?
That's a sobering inversion. In that scenario, maybe the Horizon drugs face unexpected competition or hurdles. Maybe MariTide is a commercial flop because of side effects or just being outcompeted. Then Amgen is left with a weakened balance sheet, a declining legacy business, and an expensive acquisition that doesn't deliver.
And that powerful free cash flow.
It gets eaten up just servicing the debt, starving R&D for the next generation of drugs, maybe even forcing a dividend cut down the line.
So what stands out to you? Is Amgen undergoing a necessary, maybe even brilliant reinvention to secure its future? Or is this a high-stakes gamble that could turn a historically great company into a classic value trap, slowly fading away as its cash flow gets consumed by past decisions? Something to definitely mull over as you think about the future of biopharma.